4 or 5 different methods that I consider supplementary, but the basis of my work are channel structures. So you have a series of parallel lows and highs that might be descending or rising over time. And that is a mathematical pattern in and of itself. And if you've got a descending channel and the top of that channel has been holding highs and then we fall away again to a new low and we hold inside of that parallel structure, when you close above the top of that channel, if you violate the top of the channel, you have really a disruption of a pattern. You have a buy signal. And so
Okay, welcome to Investing for Generational Wealth. I'm John Clive from Clive Capital, where we help high earners just like you invest outside the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income and cash flow, and tax benefits. And together with investors, we're investing in over 1,000 multifamily apartments and under renovations and over 500 single-family rental homes under development. And we're expanding into private debt, industrial, commercial real estate, oil and gas ventures, and much, much more to create a diversified, balanced portfolio. And before we begin, just like always, a quick disclaimer. We are not financial advisors. All investments are subject to risks, including the possible loss of the money you invest. So please perform your due diligence before making any investments and consult your CPA, your tax attorney, your financial advisor, and others before making any investments. Great. So I'm your host, John Lai, and welcome to today's episode, Analytical Methods for Predicting Future Market Behavior with Cary Artac. Cary is the founder of Artac Advisory, where he shares expert insights on analytical methods for predicting future market behavior. And he advises traders, brokerage firms, large-scale commodity producers on market trends and price movements. So you might ask, why do we have a commodity trader on a passive income podcast? Well, especially in this tumultuous market, where the equity markets are moving 10% up and down, there's always money to be made if you know where to look. And Cary is here to help us with that today. Cary, I talked a little bit about your background. You want to give a little bit more detail on how you got to where you are today?
Yes, sure. So you're right. I still am a commodities analyst, and I have an advisory service since 1996 that initially catered primarily to floor traders in Chicago, where I came off the trading floor from 86 to 96. But that industry sort of died out. What died out was the open outcry trading pits. And so it went mostly electronic by 2006, 2008. And now my clientele are actually the commodity producers themselves. So it's more of a business to business relationship where I'm providing analysis in corn, wheat, soybeans, live cattle, crude oil. But, because I'm from the Chicago trading floors, some of the most active instruments were the financial futures, the 30-year Treasury bonds, the S&P 500. E-mini is still a market that I follow, that I provide guidance for many of my subscribers. I also need to mention that about 4 or 5 years ago, I started a second company with my 2 youngest kids who are 26 and 28, coming right out of school during the middle of COVID. My daughter, who had web development experience in college, suggested, Dad, we should start a stock advisory service online. I'll build the website, and I started providing some analysis. Her little brother joined us a year later. He's been with us for 3 years now, and he's an avid technician himself. So I think the purpose of today, I'm going to show you more on the wicked stocks, the stock analysis side, although we can talk commodities if you like. The methods are the same. So when I was back in the day, so to speak, in the 80s, late 80s, early 90s, when I was still sort of learning my craft, I was just poured through numerous textbooks, John Murphy's financial analysis of the commodity markets and the financial markets. And so there were computers down there that I actually, one of which I still use to this day, that had numerous technical studies. And so I spent many months just sort of fine-tuning those methods that I thought made the most sense, that I thought were the most reliable. And quite honestly, it is the channel structure. Now, I use 4 or 5 different methods that I consider supplementary, but the basis of my work are channel structures. So you have a series of parallel lows and highs that might be descending or rising over time. And that is a mathematical pattern in and of itself. And if you've got a descending channel and the top of that channel has been holding highs and then we fall away again to a new low and we hold inside of that parallel structure, when you close above the top of that channel, if you violate the top of the channel, you have really a disruption of a pattern. You have a buy signal. And so this is really what we comb hundreds of stocks for, my son and I, large to mid cap stocks primarily, some which the AI stocks can move substantially. But we really look at everything. And yeah, we've been doing that for 4 or 5 years now. We're growing. We've been doubling every year. In the last 6 months, we've been getting more and more into podcasts, getting the word out. We have a YouTube channel that's free. So I thought I'd at least plug that for any of your viewers who want to see our work on a day-to-day basis. They can go to Wicked Stocks on YouTube and see our daily NVIDIA and daily Tesla analysis. We do it every single day. But anyway, that I don't know if I answered your question or not, John, but that I kind of caught you up on what we do.
Yeah, you did. And thank you very much for that. So for those individuals who are, and most of our audience have invested in 401k, maybe apart from the RSUs, 401k, IRAs, but in traditional public equity markets, those portfolios are subject to the up and downs of winds of the broader market. What would you say in terms of being able to weather the storm or maybe take advantage of the up and downs? What you do can help them do either of those? People who are interested in maybe taking advantage where there's blood in the streets, how do they look at the portfolio and what should they be doing with their portfolio today?
Yeah, well, the question when the market, for instance, in the S&P 500 and the Dow Jones and the NASDAQ 100, we basically, since the December high, have kind of a double top. And then the market broke below the intermediate low. So we broke below all that congestive trade that's lasted the last few months. And the question, is this a good high? Are we going to continue further south? Are we entering a new bear market? The last time we had a protracted bear market was from really the fall of 21 into the fall of 22. And you can see that pretty clearly on a chart. Now, since October of 22, we've been in this 2-year uptrend. And the way I see it, that 2-year uptrend is still intact. We're actually coming close to testing channel support that is rising over time. I could show that in a moment on the S&P 500 chart. But as far as I'm concerned, as long as we're holding above that rising 2-year channel bottom, there's no reason to exit a large portion of your portfolio, that this is just kind of a temporary pullback. This shakes out a lot of long position players, and then then people load up again, and then we continue on. And I think as long as we're above a certain price point that we came close to testing this week, and we probably will test it over the next week or two, that over the next 2 to 3 to 5 months or so, we can push through those highs that we just had about 6 weeks ago and on up to other key price points. So I still see the 2-year bull trend as bullish. It's just that the near term is rattling everybody's cages. And the tariffs today, not tariffs tomorrow, that back and forth is certainly creating an environment of uncertainty that lends a lot of fear. But regardless of all that, I still see the market as bullish into later year. Now, if we break this 2-year channel bottom, that's another story. And I do think the risk is then to the downside longer term. And by that, I mean into later year. And I actually have targets that I can show in the event that that were to occur.
Okay, fantastic. Let's get into it. And I guess keep in mind that a number of our audience members don't really or haven't really had a chance to understand technical analysis. So a lot of the terms you're using, you might have to explain to
Well, I will, but what I love about channels, and they're so simple. You have to draw them, you have to create them properly, but a picture is worth 1,000 words. And when some of your viewers see what I'm going to show, they'll be like, that makes a lot of sense. Can I share my screen?
Yes, you may.
Great. I'll go ahead and do that. There we go. Can you see this?
Yes, I can.
Perfect. So this is a weekly bar chart. Every one of these vertical lines is a full week in the S&P 500 index. This chart goes back to September of 19. So this is a 5-6 year structure. You can see we had the big rally from March of 20. This is the COVID low. And then we had the January 22 high. This is that bear market I was talking about that lasted for the better part of a year. Yep. And coming off that October 22 low, we have this sequence of highs and lows, and you can see see that you can draw a channel here from the November 22 high against the recent highs in December, project off of that same rate of ascent or rising channel structure off the October 23 low. And we've got, and these are exact numbers, 5474.84. We came close to testing it this week, and we may still test it this week. It's hard to say, but this has been an objective following the settlement below this channel structure, which is nothing more than a trend line off the highs, project off the middle low. You've got this consolidation pattern that was violated last week. So this is when I said earlier that when we break this intermediate low, you've got the entire financial world is wondering whether this is a sell-off that will play out longer term or whether this is a sell-off to buy. And right now, holding above 5474.84, which next week you can see is 5493.88. If you look in that yellow box, climbing weekly, this is an area to buy into. Now, what could happen over the next 2 to 3 weeks is we bottom out at 54.74, we rally back up to 58.07, and we kind of fill this wedge out for a few weeks. That can quite easily happen. And if we then close above 58.07, then I see bullish continuation a longer term. I can show that here, that if we close above 58.07, back above this structure that was a near-term sell signal only, I would expect within 2 to 3 to 5 months or so, a new highs beyond that high from February of 61.47 and on up to a 5-year channel top. This 64.40 climbing gradually is a significant test of overhead resistance. If tested later in the year, can contain annual highs and we can fall away from here again. But if, on the other hand, we close below this 5474.84 level at the end of this week, that is Friday, I think there's a pretty solid case for later in the year falling to this 5-year channel bottom that is presently around 4,500 and climbing. So these are the very simple things that I look for, but the 2-year trend is still bullish. There's no reason to be shaken out of a portfolio, in my opinion. This is just a short-term shaking of the tree, so to speak, below 58.07. This can hold through the rest of the year, perhaps, or at least into summer, fall trade. And from here, once again, we can round up to the 64. In fact, it would be kind of like this. It'd be the same sort of channel structure that we could rally up into. So yeah, that's the S&P. Now, if you don't mind, can I move on to Apple?
Sure, you can.
Or are there questions? I'm sorry, I don't mean to move.
No, that's great. Okay. And audience members, if you have questions, by all means, send them along. Did have one quick question on short-term versus intermediate versus long-term. I understand roughly like the time frames, but what did they tell us, short versus intermediate versus long?
Well, that's a great question, because one of the things that I've done for years, and on the trading floor back in the late 80s, early 90s, my work was unique because the floor traders are all about day trading. Where can I buy it today? Where can I sell it today? But sometimes the market would stop dead in its tracks at a structure that you could only find on a monthly chart going back 20 years. Maybe it's a 10-year channel top coming down. And so I always start with the long term and work my way into the near term. I break my time frames into 2 to 3 months and beyond, and then 2 to 3 weeks, and then 3 to 5 days, and then the day itself. And so I've got about 4 different time frames I work. And when we close below 58.07, my 2 to 3 week time frame turned bearish, while my 2-year or my 2 to 3 month time frame remained bullish, or one of buying the market at an opportune price point below the market, presently at 54.74. So I don't know if I answer your question, but you can have, and I've said this many times, you can have a near-term bull market that exists within the confines of a long-term bear market. In other words, like a counter-trend rally, as they often call it. But it can be a very well-defined 3 to 5 week channel structure that you're buying every dip. If you're kind of a 2 to 3 week swing trader, it's a great opportunity. But maybe the 2 to 3 year market remains bearish. And so you have to put it all together. I mean, there's as much of an art as there is a science to technical analysis, and being able to take a look at all the charts and put it all together into a cohesive framework. I think it takes a while to really kind of understand how to do it well, and then to articulate it to your subscribers and your clientele.
Perfect. Okay. Let's move on to
Sure.
Google.
Yeah, I'll take a look at, well, here,
Apple,
let's take
yeah.
a look at Apple. Yeah,
Right.
Apple, no problem. So that 5-year channel top that I mentioned in the S&P 500, Apple actually tested its 5-year channel top back in December. This was actually considered, here we go with another channel structure. This 1-year channel structure we traded inside of, and then last June, we had a buy signal. This was an AI announcement by Google, and when we closed above this channel top, which was in the mid 190s, our objective became this 264.91 channel top. So this was from the mid 190s into like the 250s. I mean, this was a nice play, 25% plus a move to the upside. We hit this channel top back in December. It held almost to the tick, and we have since fallen away. And really, if you're looking at channel dynamics, this is a 2-year rally. This is a 1-year sell-off. This is a 2-year rally. We can ease back to 180.01 channel support, possibly by the end of this year. I don't see a clear sign for that. But when I look at channels like this, I have to respect the possibility for the market falling back to the channel. What is the indication for that? Would come with a settlement this week below 2 converging channels. One is these are near to midterm channels around 210.51. This, by the way, 210.51 is a beautiful area to buy Apple as we move through the second quarter, because from here we can round up back to that 264.91 5-year channel top again within 2 to 3 months or so. But if we close below 210.51 at the end of this week, and these structures are changing a little bit every week, then we have a clear sign for 180.01 as a 2 to 3 month downside target. So as I said before, 264.91 is your ceiling through the year, really. 180.01 is your floor through the year, and 210.51 is kind of this intermediate pivot point that could actually contain selling. You can buy this anticipating possible upward rotation into the 260s and higher within 2 to 3 months. But if we close below 210.51, forget about it. You're either out of the market, or you're short, or you're reaching for, say, 180 strike out of the money puts that don't expire for at least 6 months. That sort of thing. Those are the kind of plays that we would recommend. But this is a pretty well structured channel that you can see. We can talk Google. Should I show that too?
Yes, yeah, that would be great.
All right. Yeah, here's a great example of Google. This was a stock pick that we put out on Wicked Stocks back in March of 23, when this very well-defined descending channel top, it actually held February of 23. We fell away for a couple of months, and then in March of 23, we closed above it. And there was some hesitation here for a couple of weeks, but we then continued on. Our objective was the high of 152.10 from January of 22. And this, we were trading around 104 at the time. So this was a gain of about 50% that we were looking for. And it took the better part of a year to reach it, January of 24. And then we just took that out and continued higher. Right now, if I'm looking at Google, we have, once again, a channel support. That has been an objective since a February sell signal when we closed below. This is a great example, John, of near versus long term. You have this very well-defined 6-8 week channel bottom. Back in February, we took it out the week of February 3rd. At that time, we can construct a newly formed, a rising channel bottom that is now at 161.54. This has been a 2 to 3 month target since we closed in February below this 192 channel bottom. We're very close to reaching it, 163.24, this week's low. This is where when you get within 1% of these structures, you can begin bottom picking the market, as they say. Now, if we close below 161.54, that's another story altogether. I would expect a bearish continuation as we move into April, May, June. But for right now, this is a great illustration of buying kind of a longer term support structure. I mean, this goes back 9 months or so, buying this in anticipation of upward rotation back into the 190s or low 200s quite easily over the next 2 to 3 months. And that's a great area to buy Google at this point in time.
Have you, and thank you very much for that. I am curious whether you've overlaid this on top of news, whether it's impacting Google or other players in the market, for example, generative AI or AI news, that might have impacted some of the movement that you see in the stock chart for Google.
Yes, I mean, it's hard to isolate yourself. I don't. I do read the news and I pay a passing glance to some of these things, but I try not to digest the fundamentals too much, and
Yeah.
it winds up bleeding into my analysis subconsciously. So, like for instance, if I get a bearish report, an article that comes out that suggests Google's going to have a tough go of it, I might then just sort of lighten up on my perceived support for 160, 154, and I don't want to do that. And I'm not quite sure what the news might have been. Oftentimes, I don't even pay attention to it. I do strictly follow the technicals, and I leave it to others to do the fundamentals. There's only so many hours in the day.
Yeah.
But I do think the technicals are a reliable enough structure for trading. What I love about them too is you can really define your risk. For instance, when we closed above this 104 channel top, first off, we recommend to our clients to never risk more than 2% of your overall trading capital on any given trade. And if you allocate 10% of your portfolio to any of these particular stocks, that means the stock itself can drop about 20% before your 2% maximum threshold has been hit. And you rarely ever have to do that. In fact, if we close, and we didn't, but after closing above this channel top, had we closed back below it at the end of a week, we would have been out of this trade. And typically that would be just a 1 or 2 percentage points on the stock itself. In other words, 1/10 or 1 or 2/10 of your entire portfolio. So I love a technical analysis because it provides a clarity, precision. You've got exact numbers. There's not a lot of guesswork. You can employ discipline. Trading discipline is important. And if you've got a good risk management strategy where you only risk a certain amount of your portfolio in any given trade, if you rely on it, if you're comfortable with it, if you're confident in it over time, it will reduce the elements of fear and greed. The trading psychology is huge. Trading psychology is huge in any endeavor, whether you're investing in real estate or whatever the case may be. If you're confident, if you know exactly the what if scenarios and what you're going to do if it goes south, if you've got a history of doing that and you're confident that you will bail when it's time to bail, it will sort of reduce the elements of fear and greed, which I think can wreak havoc on anybody's account because it'll shake you out of a position that ultimately may win nicely.
How have your subscribers, your investors capitalized on the signals that you see here? Obviously, you have a subscription service, but do you recommend that those individuals then follow those signals and then put in place an option strategy to take advantage of the signals?
Well, our subscriber base runs a wide range from the experienced investor. My first subscribers to the stock side of the business that we created 4 years ago were some of my commodity trading subscribers, and they typically have a very thoughtful risk management strategy, and they kind of know what they're going to do anyway. And many of them are experienced options traders. And then the other side of it are new traders who come in who really don't have any experience. They don't understand that really the crux to good trading, effective trading, and investing is in risk management. Anybody can write a winning position. Well, not everybody. A lot of people don't know how to write a winning position, but when the going gets tough, when the market is down, where are you going to stop out? That's what always playing defense, right? So it runs the range. So I don't really have a pat answer for you. What we do is we present the analysis. We say, for instance, 160, 154 is a solid zone to buy into. We'll also say something like, as you get into the 1% zone here, and I can kind of recreate it for you. If we get into this line is probably very close to 1%. So as we get into the 1% zone, you can begin to buy it. And for some people, that will be 160, 250. Others are going to wait for 160, 154. And you might put a resting bid. This is the interesting thing about stock investing is when you get into a stock trade, are you bottom picking the market or are you waiting for it to come off support to show that it's a valid, like right now you can see this was a valid buy. We came off of it modestly. The question is, are we going to see the market pull away from here? So we kind of lay out the strategy, buy it if we close above, like for instance, this is a great example. This was a buy signal that we put out back in March, And we'd mentioned that if we close above this channel top, you should go long the market. Some people go long immediately during the trading day, the very first hour that actually occurs. They don't even wait for the market to close. And there's nothing wrong with that. Others will wait for the end of the week. They'll let it play out for a few days before they then enter the trade. And there's nothing wrong with that. There's really no right way to do it. Each has its costs and each has its benefits. The guy who gets in early is going to have to probably endure some uncertainty, maybe some whipsawing for the next few days to see what happens. But his advantage is he's getting in early. So he's got a price point that is a lower price over time. The guy who waits around until Friday, he may have to buy it at a much higher price point when he's got actual validity at the end of the week. We do say that the weekly settlement does have a degree of finality and closure that the daily settlement does not. At the end of the week, many people just know the decisions they're going to make, and those decisions are made. And if we close above a structure like this at the end of the week, our opinion is Alphabet or Google will continue higher, back to that 152.10 high in the months ahead.
Do you find that, and I'm looking at these charts, that the weeklies, any individual week is not as critical, as important to look at versus, call it, a month or 2 months or so, and the stock movements of that month? I know you look at the what looks like maybe a month and then a couple of weeks and then over a period of, call it 4 or 5 months or 6 months. You find that, like, if you're just looking at that one particular month, yes, you have signals that you might surpass that ceiling, break the ceiling, but that week, as you say, may just be a blip and then it just goes sideways and it might go back down, or there are true signals and you should wait. If it breaks that point, then you should really buy in, because over the long run, the technical analysis is showing that it will run up or it will run back down.
Well, I don't typically favor one week over another. I can actually show a good example of this right now in Tesla, if you're following Tesla, and lots of people are.
Yeah.
So this is a Tesla. This is a weekly chart for Tesla.
Yeah.
And we had a series of, well, I can actually redraw it right here. There's a channel top that we settled above several months ago that at the time indicated basically the high area that we saw from December. And then we came cratering back, and it was 3 weeks ago that we settled back below that channel top. That was a sell signal down to this 2-year channel bottom. And so I'm trying to make your point, or maybe address the question that you have, and that is we hit this channel bottom last week, and we came off of it very modestly. This week it's at 256.44. Now, so far this week on Monday, we opened below it, and we fell down to 217.02. But today, the last couple of days, we've had a nice recovery. So the way I see it on this weekly chart, I'm bearish below 256.44, but not quote unquote officially, because we haven't closed the week below 256.44. And we are close enough to 256.44, and I don't see any evidence of this just yet, but I wouldn't be surprised with the kind of volatility we see that if we close Friday above 256.44, all bets are off to the downside. But if we close below 256.44, then we enter another sell signal. This is a base of support between 153.59 and 159.69 that I would expect, with the present rate of descent over the next 3 to 5 weeks. If we close Friday below 256.44 in Tesla, I would expect 153.59 to 159.69. This is a 5-year channel structure. I would be surprised if we took this out, but I do think that the 150s is an area that can contain annual selling pressures, and I would expect it with a settlement Friday below 256.44. But the week, we're still in the middle of the week, and so if we close Friday above 256.44, then I will begin looking at other elements for what is my upside target now. Because if we close above 256.44, despite how ugly and sloppy this was, you can't see it, but that the market is likely to continue higher again as we move into April, May.
Yeah, I like that. And it's very appropriate, right? The audience members were investing in Tesla, we're investing in NVIDIA, we're investing in like these high-flying stocks, which, call it 4 or 5 months ago, they seemed unstoppable, right?
Sure.
Now they're looking at the broader market and how it's impacting these stocks, and it's definitely not unstoppable. And in fact, looking at a technical analysis like this, it's helpful to understand where the floor might be, and then where the breakthrough points where you might want to reinvest in the stock.
Let me show you NVIDIA, because you did
Yeah.
bring that up. And we cover this every day as well at wickedstocks.com. And so this channel top at 138.60 actually held nicely back in about 4 weeks ago. And following the pushing into this channel resistance, we'd mentioned how channel support would be in reach within 3 to 5 weeks. So we're holding inside of this area. Now, this channel bottom at 107.78 is the backstop as far as we're concerned through the second quarter. So from 107.78, holding above 107.78, we were telling our subscribers to buy 107.78 and to not sell unless we violate 104.94, which is this descending channel bottom. So as long as we close the week Friday above 107.78, and that looks likely right now, we've got subscribers long anticipating recovery now over the next 3 to 5 weeks into the upper 130s. If you were to, I'm actually going to show you, I'm going to back out of here just for a minute because I do want to show you what I think the big picture is for those of you, is really this channel top. So as I mentioned before in Apple, we test the channel top and we've got that long-term 180 as a channel bottom. Holding above 107.78, I do see the 162, I'm just going to do it roughly, this low 160s and climbing as a likely 3 to 5 month target that becomes a clear objective if we can over the next month or two close above 138.60. So once again, these are channel dynamics. If we close this week Friday below 107.78 by a full 1% margin, I think that's around 106.12. Some people aren't going to bail out of their long positions unless we also close below 104.94. So we leave that option open to them. But if we do close merely below the 107.78 structure by a 1% margin, that is then a sell signal to 76.89 within 2 to 3 months or sooner. This could be a 3 to 5 week collapse as the volatility begins to expand. 76.89 is a 2-year channel bottom for NVIDIA, and this is about as far south as I would expect it. I'm also going to show here, this was a beautiful play we had on Wicked Stocks. I'm going to redraw it right here. This was the breakout in NVIDIA back in May of 23, when we closed above this long-term channel. Once again, a beautiful example of channel structures, how we closed above it, got a nice rally, we fell back to it. We then put out another video. This is a great buy opportunity at this, at the time it was around 39.25. Now, we had no idea we were going to get up into the 150s at that time, but we were telling everybody in the world to buy NVIDIA based on the violation of that channel top. I tell you, actually, what we were looking for is a full channel extension. We use that as a targeting mechanism a lot. It was somewhere around here. You can see this low. I remember that held nicely. So we reached our objective in January of 24. We gapped above it the following week, and then it held 3 weeks later, and we just continued onward and upward. But it seems so long ago, and it was such a lower price point. But yeah, this is what we're looking at now for NVIDIA.
How do you find stocks like this? Because I would imagine there are many stocks that could break out into exceed these ceilings and then be signals for your buyers to buy into a stock. How do you evaluate which ones to look at of the hundreds of stocks in the market?
Good question, because we also do a triple Q and SPY analysis, which is the NASDAQ 100 ETF and the S&P 500 ETF. And one of the reasons we do that is because it caters to a wide range from the day trader all the way out to the institutional portfolio manager. And why it's such a those are two great entities to trade is because of the volume. The volume is important for trade execution. It's also important for sustaining rallies. If you look at a small cap stock that has very little volume, it just gaps all over the place. It'll drive you crazy. Stopping out of a losing position can be ridiculous. So we look for volume. We look for mid to larger cap stocks. A lot of them are household names. And we probably comb through, we have them on alert. So for instance, with respect to NVIDIA, we have alerts that will tell us, are we getting within 5% of our target? And then when the market hits this line, our alerts go off. And so we don't have to watch 500 stocks at once.
Right.
But it is a very manual process. There's really nothing automatic. There's no AI about this. This is just a visual. I do have a software program that draws these exactly to the very tick, so we know exactly where they are. But this is NVIDIA is a big stock, and it comprises a large portion really right now of the NASDAQ 100. And so you have to follow it. We follow every stock in the NASDAQ 100, and we put our alerts out. We draw these structures where is the good area to buy, where's the next buy signal, et cetera, et cetera.
You talked about automation and maybe AI. Have you thought about applying AI or agentic workflow agents of generative AI models to this so that you can, because it does seem like there's an art to it, but you can apply some of your knowledge into technical analysis?
I've thought about it, and I'm sure we'll move in that direction, but I think I'm terrified of it, as many people are, because I don't want to be replaced. We've got businesses that are growing, and the moment I realize that I could be replaced by AI, it will just drive me crazy. So, but no, in terms of time saving, I think you're absolutely right. I'm sure, and actually, I had a programmer. This is about 15 years ago. I spent a few weeks with him trying to create an automated algorithmic program that could recreate these structures without me having to really open the charts up. But we could never really get, for instance, and this is not a great example, but let's say that this high here, 149.77, was right on the same line of 151.79. So you've got these two highs hitting it. I always like to go with the extreme high, the highest point. That could mean using, and while it's technically not the highest point, it could mean using that first high, because it means that if you draw a trend line across it, the second high is below the trend line, if you follow me.
Yep.
So that's the one that I want to use. I want to use the extreme. I don't want to cut through trade in order to create the line.
Right.
And attempting to get him to write an algorithm or a trading program that could say that and reduplicate it just proved to be next to impossible. So we abandoned it. Now, I imagine AI could get around that. So, but I don't know. It intrigues me for time saving elements, because there's a lot of pencil pushing that we do to get this work out every day. I do know that there's AI elements can do that, but I think your question is more toward analyzing the markets as I do subjectively, visually like this, just with discretion. Can AI recreate that? I imagine eventually it absolutely will, but I hope that day doesn't come too soon.
Well, if it does come, hopefully you're behind that.
Yes.
That algorithm, like you built that large language model to be able to apply the theory behind and the application behind how you run a technical analysis.
Sure.
So for those that are interested in finding out more information about this, but maybe don't have the time, is there a programmatic method, meaning not so much automated, but is there something where they say, I have 50K, I have 100K, I'd like to invest in something like this, but I don't want to do the work? Is there something that allows them to invest in this type of model?
You mean as an automated algorithm?
Or not so much automated as much as handing over to an advisory firm like potentially yours or others to be able to take that money and then apply what you know to it and do the trading?
Well, we're not in that at this
Yep.
point in time. We're just providing analysis. So, it would be great if I could say, go to so and so who's following our analysis to the T, and they'll manage your money for you. But we are going to get into that. We've just got so many plates spinning. I think over the next year or two, we will have a Wicked Stocks fund. My son is very interested in starting that, using all the signals that we use and then managing money. We do get requests from clients who want to give us a portion of their portfolios to manage. So it's sort of in the air. We just haven't acted on it yet. We're still kind of finishing out our product, so to speak. But I would say we have a subscription at wickedstocks.com. There's a 5-day free trial. People can take it for a test drive. We offer 2 stock picks like this every week. So just Tuesday, we put one out on Home Depot that's approaching a significant channel support that may hold selling pressures through the rest of the year and represents an opportunity to buy, where if we rotate as we have over the last year and a half on these 3 to 5 month patterns, you could easily see a 25-30% return return. If, on the other hand, we close below that channel, I think personally that means we probably are in a recessionary environment because it's the home building stock and we have a much lower price point that we would expect. So I do offer options advice this all video based, by the way. So we'll put out a 5 to 10 minute video. We'll give all the specifics. What are the criteria for entering the long position? What is the criteria for exiting the long position? We give certain call strikes, put strikes, time horizons for expiration, that sort of thing in these videos. And I'll just remind that the NVIDIA that you see here and Tesla that you saw earlier, we provide for free the exact same high quality analysis with the exact same support and resistance levels that you find on the paid side with the SPY and the Triple Q and Apple, et cetera, et cetera. So it's a great way for people to get acquainted with our work and are reminded of how to actually activate a subscription. But I think this is a long way for me to say, no, I don't think we have anybody at this point in time that we could refer them to.
Okay, that sounds great. A quick question on how much of a person's portfolio, let's assume that the average audience member has a 401k, they have RSUs they can't really do anything with, but certainly they have a after-tax brokerage account or some type of options trading account. Maybe not within the 401k and their IRAs, because those are primarily mutual funds and they might not be able to risk that much with it. But how much of their portfolio should they allocate towards something like this, like a little bit more active trading?
Well, that's a good question. It depends on their risk tolerance. It depends on what their goals are long term. It depends on their age to some extent. Some people enjoy the excitement of near to midterm trading, and it can really help cushion the portfolio over time, I think. You could have two separate accounts, one that is a long-term investment that you might only touch monthly or maybe several times a year at best, and then others where you allocate more toward what you might call the more near to midterm speculative accounts. If it's the way we advise our subscribers is if it depends on their entire trading capital or a portion of their trading capital, maybe they allocate a portion of their trading capital for the wicked stocks type of trade recommendations. And then we tell them to not allocate more than 10% of that to any particular stock trade. And over the course of a year, they're going to get 100 different stock picks because we do 2 a week. And they can then decide which they feel comfortable with which they don't. Some of them never pan out. We give stock picks. How do I put this? They haven't even emerged yet, but they're close to it. So for instance, if I take you back to the Google stock or Alphabet rather, was that it? No, sorry. Yes, it was Google. This particular stock. We put this stock pick out the week before as we were approaching this channel top. In fact, I think we put our original video out about a month and a half before when we tested it. And so they know what the conditions are ahead of time. And so we kind of leave it to them. But yeah, I typically tell them not to allocate more than 10% of their trading account for each particular stock. And that account will fill out. If they start acting on some of our signals, it will fill out over the course of several months. And am I suggesting that their entire trading portfolio be allocated toward wicked stocks? No, if they don't feel comfortable with that. So that's where you kind of trade or create a second trading account or a third trading account. I know some fellows who've got 5 or 6 trading accounts that cater to different trading methods and time horizons. Time horizon is key. And it's hard to trade 2 or 3 different time horizons in one trading account. It's hard to say, okay, this is going to be long term, but this stock is going to be short term. I think it's much easier to compartmentalize and just create a second account or a third account that is devoted toward the more short term speculative trading.
Yep, like that. Okay. And of course, as Cary said, you know yourself best. If your risk tolerance is higher, definitely allocate more toward this active trading. If it's less high, don't. You might want to look into much more passive income like real estate, like a lot of the ones that we typically talk about, but those are more slow moving over a longer time horizon, right? 5 years or so. So there's a balance, and that balance, that fulcrum of the balance really depends on your risk tolerance. So definitely adhere to that advice. Curious question we always ask any guest that comes onto our podcast, which is, have there ever been an instance where things haven't worked out? I mean, obviously, things may not turn out the way that you think it is, primarily because of just the fluctuations in the market, but things that maybe lessons learned that 20, 30 years ago that you can apply today that maybe you didn't know, or you can apply to and tell your younger self?
Yes. Well, there's one moment in 1992 when I was young and trading the futures market. I was trading a futures account. I went long the British pound because it tested a long-term channel. It bounced off of there for a few days, and then the British Prime Minister John Major put out some big announcement. I forgot what it was, and I didn't have a stop. It was my early lesson in always have a stop loss. So don't think for a minute that you're going to be able to just follow the market and you're just going to get out, because it wiped me out entirely. I even owed money to my brokerage firm because it was completely upside down. In the futures market, you're highly leveraged. So that was a very painful moment, and I've never not used stop losses since then, even in the stock market. And yes, I mean, these channel structures work well. They work well in bull markets. They work well in bear markets on the sell side, but they don't always work out. There are situations where you get a signal and it fails. And so what are you going to do at that time? Well, you've got your stop loss, and then we've got the criteria that we then present. What are the scenarios by which you should get out? But typically, I don't think you should ever risk more than 2% of your trading capital on any given trade. And I think in the stock market, if it's a high volume stock, you should be able to do that for the most part. But yeah, we've got a pretty good batting average. I think last year, 2024, we put out over 100 stock picks, and over 72% of them worked out. They didn't work out as well as Alphabet, but they all hit at least a 10% return at one point. That was the criteria we used. But then there's the 30% that didn't work out at all, that reversed, and we were completely wrong. We got the buy signal above a channel, the market fell back and closed back below the channel.
Yep.
And by the way, when that happens, when you get a classic buy signal and the market rejects it, that in itself is a signal. And this took me years to learn. So that's a whole nother story. But what are you going to do that 30% of the time? And by the way, if you've got a trading strategy that wins even 52% of the time or 55% of the time, if you can combine it with effective risk management, a very thoughtful trade execution strategy, you should be able to come out ahead. But we were over 70% successful in all of our stock picks last year. But it gets back to the point that 30%, if you don't have a stop loss, and let's say you took advantage of all that 70% and your portfolio is up a certain percentage, you can give it all back by picking the wrong stock and not getting out at the right time, not having your stop loss in. It's so important. I can't, because there's these black swan events, and I just saw it so many times on the trading floor. Fellows who made lots of money year in, year out, and then they just lost their discipline, or they didn't have a stop loss, and you have an event overnight, something happens in the world, and pretty soon, not only you're upside down, but you're completely wiped out. And that can happen. So you've got to protect your capital. That's always I think in any investment, how are you going to protect your capital? How are you going to play defense? Playing defense is important.
Yeah. We have a number of questions that came in, and I just realized there were questions, but we answered some of them. You mentioned volumes being important in your trade and technical analysis. Could you speak a little bit more about that? Volumes versus if you have a small cap stock, obviously it doesn't trade in high volumes. The importance of volume in what you do.
Well, I typically like to see 1 million shares traded a day. Now, some people love the small cap stocks because they can move substantially in a short period of time. And I think that's great. And so sometimes I will make occasional exceptions. I will look at the chart. Does it have a lot of gaps in the chart? Does it all of a sudden, out of the blue, it just gaps lower by 20% one morning? And does it do it again 3 months later? I'm not crazy about those stocks. But if you've got fluidity, if there's not a lot of gaps, even if it only trades 750,000 shares a day. I mean, some stocks trade 10,000 shares a day, and they just scare me. So volume is important. Also, just from the trading floor, I came from the trading floor that had the highest volume trading pit was a 30-year U.S. Treasury bond futures. It was the largest pit in the world. And traders flocked from all over the country to trade in that trading pit. Why? Because of the volume. Because if they were wrong, they could get out quickly. If they were more, they could get in and out of the market. There's a fluidity to it. And I think that is really important for getting good trade execution. If you want to buy a market and buy a particular stock and you want to buy it at the market, you can do that in the SPY and the triple Q, and you can do that in Apple, where you've got substantial volume and you're going to be satisfied with your fill. But if you are trading more of the small cap stocks that don't trade a lot and you put in a market order to buy it at the market, you may actually move the market just a little bit and actually get a really poor price. So I just like volume because there's a continuity. Usually when you've got higher volume and you got larger cap or mid cap stocks, you've got a mature company and there's news that impacts it on a day in, day out basis. That helps the technicals too. So yeah, I don't know if I answered the question thoroughly or not.
You did. The other question that you might have answered earlier, which is how can you analyze using technical analysis but without fundamentals? And then you answered the question about timeframes, but answer the question or expand upon the answer that you gave about fundamentals, not fully entering into the equation when you do technical analysis.
Well, and I don't have any exact cases in point because I really sort of isolate myself in the technical world. That is my primary. And then if the fundamentals come into the market, I will read about it later or hear about it later. But they're just, when I was in the trading floor in the late 80s, early 90s, and I was studying technical analysis and learning my craft, I did attempt to combine the two. I thought, my goodness, it could be great if I can combine both the fundamentals and the technicals. I just never got comfortable with that because there were so many instances where I would have a beautiful classic buy signal on a chart and the fundamental data that poured in, maybe a morning report, suggested just the opposite. And so I would pause, I would hesitate. There's also, you can overanalyze markets. The cliche paralysis through analysis is absolutely true. I look at channels and I've got a few other methods that I follow. I keep it simple. When I was on the trading floor several years in, I probably had 15 or 20 different methods that I would use. And it just served to more or less create more confusion. So I just keep it simple. And for instance, with Tesla, I don't know. I know that they've got earnings and market share and you've got all this bad news, but nobody really saw this coming, did they? This big sell-off. And so, but technically we did in stages. Our coming off of this channel top, this is our first sell area, and we were expecting the 345 zone. This is right around 345. And we did bounce for about a week. I mean, we broke through it, but we closed above it. So we're still long here. And then we closed below it very quietly about 4 weeks ago. And this was not based on news at all. Although the following week there was news, as I recall, and I don't remember exactly what it was. But, you know, for me, it's just simpler to follow the technical. I'm not berating the fundamentals by any means. I've got colleagues who follow the fundamentals very closely, almost exclusively, and some of them do quite well with it. It's just that I've never felt comfortable with it. And I think presenting the technicals like I do visually in video format, I think it really helps people understand the underlying structure of a market. For instance, if Tesla does happen to test the 150s over the next month or two, I think you can see you've got these parallel structures here, this 5-year channel bottom. If it can hold through the rest of the year, and if we take it out, honestly, if we close below 153.59 over the next month or two, I don't know if Tesla is going to be the stock we've known it to be over the last few years. I think it's going to fade into oblivion, or at least into the background recesses of the stock market trading community. But right now, it's still this really hot stock that can move substantially in a short period of time.
I like it. I like it. So to close out, we do have one other question, which is, what's the subscription cost for Wicked stocks? And are there any discounts for trials more than a week?
We do run discounts. I don't have one ready to go. I wish I did. Now that I hear this question, my son could have created a coupon pass, but we don't really have one that I know of right now. But it is only $47 a month. So that's quite affordable, I think, for what you get. With the wickedstocks.com subscription, you get daily Tesla, daily SPY, daily triple Q. That's the NASDAQ 100 and the S&P 500 ETFs. Those are the tradable entities. You get weekly Apple stock analysis. You get 2 stock picks a week. You get weekly S&P 500 and NASDAQ 100. And we continue to add to it. So it's $47 a month.
Okay, perfect. Well, thank you very much for the information. We've learned a ton. I thought I knew about technical analysis. Obviously, I did not. Thank you for that. Cary will include your information as well as how to reach Artac Advisory, as well as your, obviously,
wickedstocks.com. Yeah.
wickedstocks.com. We'll include all that information as part of this podcast episode. If you're interested, do navigate over to wickedstocks.com to find out more information. And of course, don't forget to like and subscribe to our podcast on whichever platform you're listening to make sure that we can continue bringing in the best educational content ever. Thank you, everyone. Until next time, keep learning to invest for generational wealth. Thanks.
Thank you, John. Thanks a lot. Appreciate it.